Mutual funds are misleading investors? That's crazy talk. That would never happen. But we have a new study. SEC, what happened? Okay. SEC, what's going on here? SEC loophole lets funds mislead investors on performance. Good times. Why does it keep doing that? All right, I guess I have to see that Vanguard ad. Oh boy. All right, so what you need to know. SEC rule allow funds to change their benchmark, and about a third of the funds did so. Some funds change indexes for legitimate reasons, but poor performers are more likely to switch and inflows rise after they do so. The behavior appears to be legal, but seems to conflict with the SEC's transparency goals. So John Bogle had an article, maybe it was in his book, I can't remember, but man, and I had one of my first blog posts I did was on joshscanlon.com, and I've since lost all I had some great content on there. It's too bad. Anyway, it just went away. If you don't read, I can't remember what happened. I renewed the thing, but I changed hosts or something like that, and I didn't keep on. It's so painful. Anyway, this just scratches the surface. So Bogle had an article about misrepresentation of funds performance. It's just pure disgusting. This is why you have to go indexing. If you're in American funds, that's fine. If you're in Vanguard active funds, that's fine. But by and large, in my opinion, the vast majority of funds are just poor relative to index funds. It really are. That doesn't mean Fidelity Contra Fund or if you have T. Rowe Price. I'm not saying that. Just by and large, Joe Schmo Mutual Fund, you can replicate that very easily with just an index fund because you just don't know what you're buying. So let's read this study. If I can find that piece by Bogle, I'll do another video on it because it was just fantastic. Investors exploring mutual funds and comparing their returns to benchmark indexes might be surprised that the funds can change their index to make performance appear better than it is. Yep. A new study, Moving the Goalpost, found that some mutual funds take advantage of this loophole and they provide misleading information about past performance. Now, the SEC, not the football conference, Securities Exchange Commission, allows funds to freely change their benchmark indices and implicitly the historical returns to which they compare their past performers, says these two professors. But they exploit this loophole by adding indexes with lower past returns and dropping indexes with higher returns, which materially improves the performance of their benchmark adjusted performance. Higher fee funds, broker sold funds, and funds experiencing poor performance and outflows are more likely to change their indexes. Yeah. And thus, these funds subsequently attract more money because they're beating their index. All right, let's keep reading here. In essence, the SEC rules allow funds to manipulate the benchmark adjusted performance they present to investors simply by changing their benchmark index. The researchers found that 36% of the funds made changes to the prospectus benchmark at least once in over the 13-year period. Among funds making at least one benchmark change, the median number of changes were 2 per fund. So we had 36 funds, more than a third made the change. So if you look at the funds, the median made 2 changes, 2 or more changes. The median was 2 per fund, yeah. And about 6.85% happen each year. On average, funds add index with lower past returns and drop index with higher past returns. Similarly, many funds also add peer-based benchmark, reflecting other funds' average returns with low returns and drop peer-based benchmarks with low returns. And they add peer-based benchmarks with low returns and drop peer-based, that doesn't make any sense, and drop peer-based benchmarks, I'm going to assume, with high returns. That doesn't make sense. Added stock-based and peer-based benchmarks have lower returns than those of benchmarks that better match funds' actual investment strategy. Finally, the added benchmarks tend to have low returns because Finally, added benchmarks tend to have low returns both because funds choose to add benchmarks with low past style returns and because funds pick low return benchmark. Oh, geez, that's not written very well. Basically, they're saying we're going to add a lower performing benchmark or peer adjusted benchmark because it'll make us look better. It's just all what's happening. The data show that funds add indexes with 2.39% lower 5-year returns than the existing benchmark. Oh my goodness, at 5.56, 223, lower 5-year returns than the index that best matches their strategy. The probability of observing these results by chance is extremely low. So basically, they're saying at the end of the day, we're going to add funds with 2.39% lower rates of return than we had previously over the last 5 years, or 5.6% lower returns than we had than the funds that best, the index that best match our strategy. Yeah, the probability is extremely low. Anyway, there you go. So if they're changing the benchmark, you got to say, why are you doing that, dude? Why did you choose this other benchmark before and now you're changing it? And it just goes back along the lines of closet indexing and higher fees. It's just, the whole thing is nuts. Buy the index or buy a long-standing low-fee fund and don't pay any attention to the index because if you're relative to your tracking. Because they're under, like I have Wellington, my biggest holding. I have no clue what's doing relative to the index. I frankly just don't care. It's not worth my time. I like Wellington. The fees are low. I like the way it's allocated, and I'm done. Anyway, I thought I'd share that with you. Good times. All right, we'll see you